So this is part 2 of this video series in which I am comparing a fixed deposit in a bank with something called as TREPS. So in this video, I will define what is TREPS. And then in the third part of the video, we will do a comparison between fixed deposit and TREPS. This is extremely important video for traders because you need to learn how to manage the cash position in your portfolio in terms of three factors. Number one, risk. The risk on that cash position should be negligible or next to nothing. Second is return. That money should earn at least some money for us. It should not sit there idle. And number three, that money should be liquid. That money should be readily available for us because in case the market starts into a rally attempt or it goes into a confirmed uptrend, we need that cash to deploy in the market, right? So risk, return, liquidity. That is the context of this video. Okay. In part 2, I want to help you understand what is TREPS. So TREPS is nothing but tri-party repo system or tri-party repo agreement. So remember, TREPS is a system. Okay, TREPS is neither equity nor debt nor a commodity. In the vocabulary of people who put money in mutual funds, they understand three things basically. It is either equity or debt or commodity like gold and silver. TREPS is neither of these. TREPS is neither equity nor debt nor commodity. TREPS is a system. Okay, and you need to understand this system as a trader because I am making the argument through this video series that TREPS is better than a fixed deposit in a bank when it comes to risk, return, and liquidity. Return, not so much, but at least risk and return. Okay. The benefit of TREPS when it comes to counterparty risk and liquidity far outweighs the extra return that you could possibly get from a fixed deposit. But that's getting too complicated. Let's come back to the definition of TREPS. So let us say there is an asset management company. Let's try to understand this with an example. Let's say there is an asset management company. An asset management company is nothing but a mutual fund company. Okay. So they create a fund called as the TREPS fund. Okay. And they gather money from investors or retail people or institutional people. Okay. They gather money in this fund. That fund is dedicated to putting their money in the TREPS system. Okay. That money will not put money, that money will not invest in equity or debt or gold and silver. It is dedicated to TREPS. Okay. So let's say the mutual fund company creates this fund and they raise money from investors. And let's say they raise $500 million. Okay. So that $500 million is lent to a bank or a financial institutions or a financial institution which requires liquidity on a daily basis. So this money, that $500 million is lent to a bank for 1 day. So the tenure of that loan is 1 day. In exchange, the bank makes a promise to the fund that I will return that $500 million to you with interest in 1 day. Okay, that's a simple borrower lender relationship that is being established between the fund and the bank. Now, the fund is a liquidity provider, it's a provider of cash. The bank is someone who requires liquidity. Why do you think a bank requires liquidity on a daily basis? Well, the customers of the bank write checks, so the money is going from that bank to some other bank. The customers of the bank go to the ATM to withdraw cash. The customers of the bank need loan from the bank, home loan, car loan, whatever loan, personal loan. Okay. Where do you think the bank is getting the money from? Well, obviously, the money is coming from depositors of the bank, but is that money enough to take care of that liquidity needs? Right? Plus, the bank is mandated by the central bank that whatever deposits that they are raising from their depositors, a certain percentage of that needs to be kept in government bonds. Because in case in the future the bank fails, the bank needs to have some money, some assets, so that the depositors can be repaid back, or there should be some assets that the bank should be owning. So the bank is forced to own government bonds by the Reserve Bank of India because certain portion of the deposits need to be held somewhere in assets, interest earning assets. So definitely the bank requires liquidity to clear the checks, to honor depositors who are withdrawing money as cash, then to give loans, to buy government bonds. The bank needs money on a daily basis. Okay. This could be bank or any other institution, by the way, okay, which requires money on a daily basis. So the fund provides liquidity, let's say $500 million, and the bank in exchange gives a promise that I will return this money to you in a day with interest. Who decides that interest rate? The central bank or the regulator. And that is generally called as the uh, repo rate. Now, in my understanding, I think the repo rate is something that when the central bank is lending money to the bank, that is where the repo rate applies. So in this case, the interest rate could be different. I am not sure what interest rate is used here, but it has to be linked to something that the regulator is setting. Okay. The interest rate is not important here. What is important is that the regulator is determining the interest rate. Okay. That is important part here. Now go back to part one. What did I discuss in part one? I discussed something called as counterparty risk. So let's say I am the fund manager of this bank, of this fund, and I lend $500 million to this bank for one day. What if something happens in during that 24-hour period? What if the bank fails? Will I lose $500 million? Right? What if the bank goes bankrupt during that 24-hour period? I will lose my $500 million. I will lose money for my investors. Right? That's a disaster. How do you protect from that disaster? Well, there is a system created which is called as the clearing corporation. Now the third party is involved. That is why it is called as tri-party repo. Remember when you made a fixed deposit with the bank, was there a third party involved? If I put 25 lakhs in a bank as a deposit, and if the bank fails, I get only 5 lakhs which is insured, correct? So there is no third party involved. In this case, there is a third party involved. You remember what I said, that the bank should keep certain portion of their deposits in bonds. Now, what is that bond? That bond is simply a piece of paper. It's just an asset, right? A government bond is like the bank lending money to the government. The government also needs money, right? So when the bank lends money to the government, in exchange, what the bank gets is government bonds. But government bonds is not money. It is an asset. It is just a piece of paper. The bank does not want pieces of paper. The bank wants money. The bank wants cash. So, what the bank is saying is that you lend me $500 million. I will keep, let's say, $550 million of worth of government bonds with this clearing company as a collateral. Remember, in the old days, if I have, let's say, 25 grams of gold and I need immediate cash, what I would do in the old days, I would take that 25 grams of gold, go to the local jeweler, give that gold coin as collateral, and in exchange for that, I borrow money from the jeweler. The jeweler becomes the lender. Okay. And after I repay back the principal with interest, I can reclaim back that gold. So that is called keeping collateral. That is exactly what is happening here. The bank is borrowing money from the fund for one day at a specific interest rate decided by the regulator, and the collateral is kept with a clearing corporation. So this is just a custodian who holds these bonds. Okay. So in case if the bank fails, the fund can go to the clearing company okay, and take the government bonds and sell the government bonds in the bond market and recover back the investment. Now, you tell me, where is the counterparty risk here? Is this fund not getting safety? Right? So, in a normal FD that I make in a bank, I don't have collateral. What collateral are you getting when you're making an FD with a bank? You are just given a mobile application, or you are just getting an email confirmation or something that okay, you have made an FD with the bank. That is not collateral. Okay, that is just a promise. This is real collateral. That is why this system is very powerful. Now imagine this fund is broken into different units, and those units are put on the exchange to trade. Now, suddenly the game changes. Now, suddenly the retail people can participate in that fund, right? Let's say big institutions have created this fund by putting $500 million in that fund. But when you break that fund apart into units, and when you list those units on the stock exchange, now suddenly I can buy those units and I can participate in the tri-party repo system. Repo is nothing but repurchase agreement. It's like me uh, putting my government bonds as collateral, and I'm agreeing to repurchase back those government bonds. Okay. So repo is nothing but repurchase. It's like borrowing money for one day with a promise that I will buy back that bond. Okay. That is called repurchase. Don't go into technicalities, just try to understand what is happening here. The bank is borrowing money for one day and keeping a collateral with a clearing company. So in case if the bank fails, the lender can go to this clearing company, take the government bonds as collateral, sell those government bonds in the bond market and recover back their investment. This is a far safer arrangement than a normal FD. This is called as a TREPS system. Okay, in part 3, we will get into the details like why is TREPS fund better in terms of risk, return, and liquidity. Return, not so much, but at least risk and liquidity. Remember, the units of this fund are traded on an exchange. So I can, as a retail participant, I can actually buy the units of this fund and participate in this whole system. Okay, this is called as TREPS system, tri-party repo system, and the system is created in such a way to eliminate that counterparty risk on which I spent a lot of time in part 1 of this video series. I want to discuss more about this system. I would like to go to part 3. In part 2 is not enough time to discuss in part 2. Okay, there is more discussion we need to make about this, because remember that cash position as a trader, that cash position suddenly can be invested in a fund that is putting money in TREPS. Okay, and that money can circle around in this system to earn interest on a daily basis. Now, I am in this video series, I am not naming a fund, okay, because I am not a registered investment advisor or anything. You can go to chat gpt and find out funds which put their money in TREPS. Okay, I don't want to get into names, or I don't want to name an asset management company or a fund. That you can do on your own. I am here to explain to you the concept. Okay, once you understand the concept, everything becomes very easy. You know what to ask chat gpt, you know how to get information from chat gpt as to where you should put this important part of your portfolio. Let's go to part number 3 of this video series to do a more advanced discussion. In this discussion, I have only defined what is TREPS, how does this system work, and how do we come into this picture, okay, as a retail participant.